Thanks for tuning into this conversation. Lots of global news flow around us. If the Fed meet and the Jackson Hole Symposium wasn't enough, there is some very contrasting data coming in from China. When the PMI data that came out recently was slightly better than what was estimated. The largest China ETF has seen a very large set of inflows as well. So lots of moving parts in addition to what's happening in India. We love talking to Steve Brice on all of this, and today is no different. He joins us right now from Singapore. Steve, almost afternoon for you, so good afternoon. Thanks for taking the time out.
Thank you so much. It's good to be here.
Yep, thank you. Steve, what do you make of the global news flow surrounding us? Because when I was looking at the US markets, for example, and then the data emanating thereof, there seems to be a probability or a belief that the Fed might be on pause because of the weakening economic indicators and the jobs data. How would you look into it?
Yes, certainly when we look at the US economy, there's starting to be some signs at least that the economy is starting to falter here, right? So, I mean, obviously we've seen some weakness in the manufacturing sector for some time, but now we're starting to see signs that's spreading to the services sector as well. Obviously, we've got some very, very key data coming up in the coming 48 hours and into next week as well, in the form of inflation data and obviously the employment reports as well at the end of this week, and then the Fed's Beige Book survey next week. But overall, it seems to be painting a picture that this narrative that would see a soft landing in the US economy might be a bit of wishful thinking. And from that perspective, it's going to be a bit more challenging times, I think, for the global economy, not just for the US economy, but also for the global economy going forward, as we see this weakness finally coming through, that lagged effects of the monetary policy tightening that we've seen, really starting to feed into the economy now.
There is an argument being made, Steve, that there is very little reason to hold too much in US equities because the earnings yield at large relative to the real yield on either the short or long dated treasuries is not great. It's a very poor one, and therefore you might see a stagnation to maybe a marginal decline in the US equity markets as well, purely because of these technical factors, leave aside the fundamentals. What's your sense?
Yeah, certainly. I mean, obviously the valuations, whether it be just on a standalone basis or relative to bonds, in terms of the the earnings yield and relative to bond yield, they're rarely very useful from a short-term perspective. Obviously, people talk about them. At longer-term perspective, they have much greater impact on relative expected returns. But you're right; they don't look that favourable towards equities now. Obviously, bond yields have gone up significantly, and equities have gone up, so their earnings yield has come down. So from that perspective, we do still feel that we're favouring bonds over equities a little bit, particularly high-grade bonds. But that's, to be honest, that's more of a cyclical view rather than a valuation view. It's really coming down to the point we're saying, look, we do believe that we're going to go through some bumpy times from an economic perspective. That's likely to hit earnings. That's also likely to bring interest rates and yields lower. So from a 6 to 12 month basis, we do believe that we'll see some sort of weakness coming through in equities at some point. It's just trying to time that, and therefore that's why we have a preference for high quality bonds in this environment over equities.
And would that be true only for US, or would you believe it could happen in the EM space as well? Because that's very divergent, if you will, what's happening in the EMs, Steve.
Yeah, so I guess there's several ways to look at this. I mean, there is usually a reasonable correlation between what happens in US or developed markets and what happens in emerging market equities. So if the US equity market is doing well, emerging markets need to be doing something very different, I think, for them to perform well in that environment. Now, so that's sort of the first starting point. I guess the potential from a relative positioning perspective, one can argue that a lot of the bad news is priced into certain parts of emerging markets already. So obviously you mentioned in the intro that the news flow coming out of China at the moment is pretty mixed, but I would argue it's on the balance, it's pretty negative. But to a significant extent, that negativity is already priced into the market, so particularly the offshore market. So you can say, yes, you've got this headwind from potentially a pullback in developed market equities, but from a relative position, maybe they can actually outperform in that environment just because they're not pricing a good outcome at the moment.
Got it. Okay. How do you read what's happening in China?
Yeah, so I guess, as I said before, the news flow is pretty negative, whether you're looking at the economic side. So you highlighted some silver lining around the cloud, but the cloud still seems pretty big to us from an economic perspective. Obviously, we're seeing exports and imports collapse. We're seeing inflation negative, particularly producer price, but even consumer prices are starting to fall now. That seems to be discouraging some consumption going on in the economy as well, and obviously investment is lagging due to the property sector challenges, both from a clampdown on the property sector, but obviously also the credit challenges being faced by certain large property developers, and that's obviously being a bit of a challenge for them. So, the economic situation is pretty poor. We are seeing policy easing coming through, but I think the way I frame the Chinese policy response is they are really trying to focus on generating strong growth over the course of the next 10 to 20 years, and not excessively focused on mitigating or leading to a sharp rebound in economic activity. So they're really aiming to mitigate the downside risks to the economy in their interim, rather than trying to spur a sharp acceleration in economic activity. So, we're in a situation now where, as I mentioned before, from an equity market perspective, the market is cheap, but it's searching for a catalyst really to move higher. And I'm not sure what's happened so far is going to be sufficient to lead to a sustained rebound in Chinese equities in the imminent future.
Yeah. No. Okay. Just to follow up there, and maybe I should have asked this because you already spoke about China, but the point being, because the opinion around what China might do is split right down the middle, wherein some people talk about how they do not want to reflate the property bubble and welfareism, if you will, and then there is an economic argument made that they need to do it in order to revive the economy, but who knows what they will do. So, would it be safe to say that when it comes to Chinese markets, preempting and investing might be a hazardous thing to do, and therefore, would most market participants, to your mind, effectively follow an event rather than preempting it, or trigger rather than preempting it?
So I think it's a great question, right? I mean, maybe the starting point I'd have from this is saying, okay, if you're a Chinese investor, historically you've had three areas of the market to invest in, right? So you've had equities, property sector, and wealth management products, right? So property sector, obviously in the doldrums, given the policy constraints and challenges faced by the property developers there. So that doesn't seem to be rich pickings at the moment. Also got wealth management products running into challenges in terms of making their payments. So one could argue that the stock market is the place for a domestic investor to focus on. And maybe the best way to think about that is to sort of focus on areas of the market that probably have greater pricing capacity. So you've got obviously all this headwinds when it comes to the macro environment, but there's still businesses that are actually relatively cheap and can do well even in this environment. So and we're focused on the communication services and the consumer discretionary element of the market. So even without the headline growth necessarily at the index level, maybe other parts of the economy can still do quite well underneath that. So I think that's the way we're suggesting people position it, rather than trying to preempt what the government's going to do. Just say, okay, let's try and pick some good companies and invest in those in a pretty focused way at the moment.
Good. And what about India, Steve? A big rally, all-time highs, 20,000 on the index, Nifty, and then there's been stagnation of sorts the last couple of months, but the broader markets are moving thick and fast. So how are you looking at India currently?
So yeah, I guess from an India perspective, obviously, it's almost the reverse of what's happening in India, right? I think that the general dynamics are pretty positive. Obviously, we did have that negative inflation surprise which is a little bit of a headwind. But you've got generally a very bullish economic story over the next 12 months, but also over the next 10 years. So from that perspective, people are interested in the Indian market. But then you have the valuations, which is a perennial challenge for the Indian market, or theoretically it's a perennial challenge, but it just keeps powering ahead. So our sense is, look, within Asia, we are overweight Asia within our global asset allocation model, and within that we're neutral India. So we're actually suggesting that people still be invested in India because it has that positive story. If we did see valuations cheapen significantly, then given the positive backdrop from a fundamental perspective, we'd probably move back overweight. But for now, it's a neutral allocation with an overweight Asia allocation.
Point well taken, Steve. Thank you so much for taking the time out and being with us today and sharing your insights.
Thank you so much.
The pleasure was ours, and viewers, thanks for tuning in.